This meeting is being recorded.
Hello, everyone. This is Steve. Once again here for our monthly educational seminar about the magic of life insurance. I am once again with my colleague and right arm, Darren Hardison. Hello, Darren.
Hey, good morning.
Good morning to you. This week's topic is a good one. This week's topic is how can life insurance pay for long-term care services? So let's start this way, Darren. Why don't you give us an overview? What exactly are long-term care services?
Yeah, and thanks, Steve. I was going to say there's so much information here. We really could do a two-part series on this. So please keep me on track. I promise there's so much information we can get off of tangent here. Yeah, just as a refresher, when we're talking about long-term care insurance compared to life insurance, as we know, when the person passes away, the beneficiary receives a death benefit. I think everybody understands that. So long-term care, we talk a lot about it. What is long-term care? So the way I defined it, and I guess the way the industry defines it, is we're talking about long-term, hence the name, usually beyond 90 days. That's kind of the benchmark. And we're talking about chronic illnesses, typically illnesses that you don't necessarily recover from, although you may. So typically the qualifier, both clinically and for insurance purposes, is a focus on what they call activities of daily living. We've heard that term before, or ADLs. So they're talking about being able to feed yourself, go to the bathroom by yourself, cook for yourself, get from point A to point B, and then they throw in cognitive, because of dementia, Alzheimer's and such. So from a claim standpoint, as soon as the physician certifies that the individual can't complete 2 out of 6 or has a cognitive impairment, then they're technically deemed to be on long-term care claim. I think that's a good tone setter there.
That is a good tone setter. So what exactly is the care that people need and for which they need money?
Yeah, so typically we think of some sort of skilled nursing care of some kind. It can be home care. A skilled caregiver comes to the home to provide some kind of care, physical care, rehabilitation, or just help the person live, take care of themselves. Or it can be more complicated, with cognitive issues. Maybe the person isn't safe to be at home at all by themselves. They need to go to some sort of memory care facility where they're actually either part-time or full-time, in a facility.
Okay, and obviously care such as this is costly,
Yeah.
hence the need for substantial amounts of money to pay for this care. So typically people run to an insurance company when they want this money, and that's why we have a long-term care insurance. So why don't you give us a brief history of that product, the good, the bad, and the ugly?
Yeah, and just so people understand, a lot of people don't, and they expect their health insurance. If they're under age 65, if they're not yet on Medicare, they're like, oh, well, if something happens, my health insurance will pay for it. No, probably not. Probably minimal benefit, if anything. Because it's a long-term, care issue. And then once you get into Medicare and your Medicare supplements, again, virtually no inherent coverage for any type of long-term care. So to some people, that's a surprise. But again, as advisors, that's why we counsel people to, at least think about it and plan for how to pay for long-term care, issues down the road. And we like to say, even if you choose not to make a plan to address long-term care expenses, in essence, you really have made a plan. You're just saying, well, if something happens, I'm going to pay out of pocket. And that's a plan. And if people have the resources, and if their, financial plan can tolerate a long-term, healthcare cost event, then that's fine. Long-term care insurance of different varieties, you can leverage money to pay for long-term care in the future.
Okay, so medical insurance, whether it's government funded or private companies, is going to provide minimal or best short-term care, money for short-term care. So we need money for long-term care. Therefore, some people buy long-term care insurance. Is that a good deal?
Yeah. And just real quick, and where you were going with that initially is, let's talk about the different types of long-term care insurance that are out there. So, let's say the oldest, the original form of long-term care, we call it standalone long-term care insurance. Relatively low cost. You're paying for like a daily benefit, or sometimes they'll say it a monthly benefit, a pool of money, meaning if someone were on claim for a certain amount of time, this policy would pay $300 a day until the pool of $400,000 was depleted. Very cost effective. That type of insurance, gosh, I think it's been around 30-40 years. That was the original long-term care insurance. It's not, I liken it to term life insurance, in that you're paying for pure insurance. If you need it, it's great. It's relatively cost effective, unless you wait too late in life to try to purchase it when the premiums are high, or if you're medically precluded, meaning you don't pass underwriting because you've waited too long and you already have medical issues. But there's no inherent values. There's no cash values. Very few, if any, have any type of a death benefit. And if you're, knock on wood, if you're fortunate enough to have never needed long-term care, you've probably paid thousands or tens of thousands of dollars in premium over the years, and there's never been a benefit paid. Yes, you've had the comfort knowing that you've had the insurance, but if you don't use it, you lose it. So that's always been the concern on standalone long-term care. And then in today's world, what we're seeing, you and I were talking about this, clients are getting huge premium increase notices. When the companies set the premiums for these policies years ago, frankly, they underpriced them, and they didn't anticipate the longevity that we're seeing in clients today, right? Medical care and, all the good things that technology has brought us, people living into their mid 80s, 90s, hundreds. Insurance companies didn't account for this. So they're seeing these claims, and people being on claims for, years and years and years. I don't want to say insurance companies are going broke, but it's not a profitable business. So what they've done is to go to the state insurance commissions, and they have petition for premium increases, and they get granted. So you got Mrs. Smith, who's 80 years old now, on Social Security and no other source of income, and they're sending her a 70% premium increase notice. It's it's tough.
Very tough. And along the lines of what you're saying, I remember reading that another area where insurance companies missed the boat was that they expected smaller persistency. They anticipated more people would be dropping the coverages than have. So more people have stayed with the coverage, and that's why they're filing those claims.
Yeah. And I think standalone long-term care, it has a place. We still sell it today in certain circumstances. But I guess the trade-off to having a very, relatively low premium is, chances are, you're going to see a premium increase at some point in the future. And, if you change your mind, or if, circumstances change down the road, you don't have a lot of flexibility. So, leave it to the insurance company. So what do? They build better mousetraps, right? So a number of years ago, companies started introducing what they call hybrid long-term care. So the way the hybrid policies work is, in essence, they kind of built it on like a life insurance chassis, but the ultimate purpose was to leverage premium dollars for long-term care benefit. So maybe the policy, the death benefit might equal maybe the premiums that you've put into it. Say you put in $100,000 over a number of years. When you pass away, the beneficiary is still getting that $100,000. It's not disappearing. So there's benefit there. Most of the hybrid policies have some sort of return of premium feature, meaning, oh gosh, my circumstances changed, something fortuitous or unfortuitous, 12 years down the road, I don't need this policy. I'm going to surrender it and get back. It's not always 100% of the premium, but it's usually, the majority of your premium you've paid into it. People like that. People like knowing, that they can get money back if circumstances change. Where they're really good is, say you've put in $100,000 of premium, the leveraging effect, and some of them have inflation riders or whatever, and it depends on the age that you started. By the time, you're statistically likely to need long-term care, you're 78, you're 82, 87, whatever, that pool of long-term care benefits probably grown to 500,000, 600,000, 800,000. So it's been this huge leveraging effect where, that's going to more than offset their long-term care expenses during their lifetime. So that was a cool thing. Now to get to the actual topic of what we're talking about today, again, insurance companies are clever and consumers are more savvy and they're demanding better products. So a little bit later than the hybrid policies, they came out with long-term care riders on permanent life insurance. So it's what it sounds like. I go out and I buy a $500,000 life insurance policy. It's a fully guaranteed policy. It's going to stay in effect for my entire lifetime, as long as I live, as long as I continue to pay the premium. If I die early, or if I die life expectancy or beyond life expectancy, my beneficiary is getting that $500,000 life insurance. Where the long-term care comes in is, well, gosh, what if something happens? And again, we talked about our ADLs. All of a sudden, I can't complete my 2 out of 6 ADLs. My physician certifies it. Now that $500,000 that's a death benefit also becomes long-term care benefit, and they'll pay a monthly benefit as long as I'm requiring long-term care services until that $500,000 is depleted.
So I buy a $500,000 permanent life insurance policy. If I fortunately do not need any long-term care services, that death benefit remains intact and my heirs get that money. If I do need long-term care services, then I'm in essence liquidating the death benefit while I'm alive to a maximum of the benefit. So I have a maximum of $500,000 to use to pay for nurses or aides or whatever else I need.
Yeah, and it's satisfying the client and the financial advisors like myself who want to be sure that money is going somewhere. We hate insurance that just poofs disappear, and we've seen the premiums go out over the years, but there's never any benefit either to the insured or the estate. Here, it's good for people that maybe don't know. Some people don't know. It's like, well, I know I'm going to die someday. I think we all know that. Long-term care, maybe I don't have any family predisposition for advanced stages, or no one in my family I've never seen anybody require long-term care services. We just die. My dad, he just died. My mom just died. And it sounds morbid, but what I'm saying is if you don't have an experience, maybe you
I think we're having a technical difficulty. Let's just bear with Darren for a second.
We got kicked out for 1 minute.
I gotcha. So we're talking, you were talking about if somebody doesn't have a family history of chronic illness that results in long-term care, so then what? Uh,
Oh, there you are.
yep.
Okay, we're back.
Okay. So you were mentioning that a consumer would kind of make a decision about buying the product of factoring in whether or not they have a family history of chronic illness in older age. I apologize, folks. We are having technical difficulties and Darren keeps fading in and out.
Yeah, yeah. Okay, I hear you now. And I was rambling. I don't know where exactly where I lost you, but I think where we had left it was.
So what we're going to do is we're going to blame this on Florida because Darren is in Florida and Florida is a hot and humid place, and maybe this is affecting us here. I don't know.
I got you now.
All right, we'll see how long you last.
I don't know if it's on my end. I'm in the office today.
Oh, I'm
Maybe
blaming you in Florida. This is Florida. If you were in New Jersey, no problem.
we didn't pay our bill this month, I guess. I don't know.
I don't know.
No, so hopefully I stay intact here. So what I was saying on the life insurance long-term care, it's really good for someone who doesn't necessarily know, or maybe somebody doesn't have a family predisposition. They haven't seen their parents or grandparents, require long-term care services, but they know it's a thing, it could happen, and they like the idea of the efficiency of having one financial product that can satisfy both needs.
I get that. All right, I'm going to ask you a complicated, kind of tricky question, but I think it's a very relevant question.
Yeah.
So you just said the process is that unfortunately the insured has a chronic illness and the doctor signs off and said, yep, unfortunately this guy can't dress himself. How much latitude does the policy owner have in what to do with that money? Like, for example, let's suppose they had an adult child or a neighbor even who volunteered to take care of them, but they have a lot of out-of-pocket medical expenses because of medications that aren't covered by insurance and things like this. Can they take the liquidated death benefit of the life insurance and pay for it for the medical expenses instead of paying for a caregiver?
Yeah, great point. And that's something I overlooked when I was outlining the different types of long-term care insurance. So to go back, and I'll circle back here. So the original long-term care insurance, the standalone long-term care, all those benefits are what they call reimbursement, meaning, okay, you're on claim, you've had the care, your caregiver gives you a bill at the end of the week, end of the month, whatever it is. You're turning that into, let's pick on John Hancock. You're turning that into John Hancock. They review it. If it's a qualified caregiver and they've done their vetting, then they're going to reimburse you and write you a check for the amount of money that you've paid out of pocket. That's great. I mean, you're getting your money back. On some of the hybrid plans that I talked about, again, let's pick on Nationwide. They have a hybrid product. I like it a lot. What's nice about theirs is the benefits are what they call liquidity style, or indemnity style, excuse me. Indemnity style means as soon as you qualify, you're getting the benefit, right? You're not having to turn in receipts. And to your point, a lot of people, what do you want to do? You want to stay at home. You don't want to go to a facility. You can pay a family member. You don't have to be a skilled caregiver to give care. So to your point is, if I qualify and my policy pays $5,000 a month, as soon as I qualify, I'm getting a check from the insurance company, $5,000 every single month. And then same for the life insurance with the long-term care. The majority of those are indemnity style, meaning as soon as you qualify, you're getting the check every month. You're not having to turn in receipts.
So you're basically saying, again, we're assuming a legitimate claim here,
You got to,
meaning that
the physician has to certify you.
yes, you
Yeah.
know, you are unfortunately sick. Your physician certifies, okay, I get $5,000 a month. But
Mhm.
as it works out, I get somebody in my family taking care of me. As it works out, I've got very good medical coverage. There's no real big out of my pocket expenses. I could basically use that money to pay for my nephew to go to Florida. You know, I mean, I have full reign to legitimately use that money for whatever I want.
100%.
Right?
Yeah. And that's why a lot of people like it. It makes life easier on, the spouse or the family. They're getting that money in and they can use it for, whatever best helps the family. Doesn't necessarily have to go for a medical expense. It could, pay for X, Y, and Z.
Got it. All right, one last question before we wrap up. Tell us about what happens if this permanent life insurance is a cash policy and there's a cash accumulation inside the policy. Um, is that cash accessed while the insured's alive to pay for long-term care, or is it only the death benefit that would be liquidated?
Yeah, and that's another design. As far as permanent, you can use a permanent policy, meaning guaranteed death benefit. We call them guaranteed universal life, where you're just you're paying for the insurance. It also has a long-term care rider, and then one other design is, okay, I also want a policy that's going to accumulate cash values. You can access the cash values during your lifetime, whether you're sick or not. So, I mean, you can take a policy loan. Policy loans are tax-free. Sometimes people will create an income stream. I call them like a Roth IRA alternative. You take the money out tax-free. The insurance company will run a calculation. They'll say, okay, this is the max amount of money you can take out of the policy, without disrupting the policy. So the policy continues. Yeah, so that's another, certainly another benefit that can be designed.
All right, well, so the difference that you're saying, though, is that if I want to access the death benefit while I'm alive, I need to be sick and I need to have a doctor authorize this, sign off on it, and therefore the insurance company will start paying me the benefit now as opposed to my heirs when I die. However, with the cash account you're talking about, doesn't require any kinds of certification. I could access that cash under normal rules, whether it's a withdrawal or a loan, whatever the policy calls for, and do with the money whatever I want. It does not have to be to pay for long-term care services. It could or it could not, but I don't have the same requirement of getting doctor certification to access the cash.
Mhm.
Is that what we're saying?
Yeah, and there's other ways to design the policy, increasing death benefits. So you can
Right.
design a policy to where the death benefits increased by the amount of cash that accumulates inside the policy. So it's a way to, not really an inflation rider, but it's really the closest thing you can design inside of a life insurance policy to mimic an inflation rider.
I get that. Well, Darren, very good. So you've given us a good, short and sweet look at the world of long-term care and the roles of various insurance products. Is there anything you'd like to offer in summation?
Again, all the different designs can be suitable for different circumstances. As much as I knock standalone because that's the oldest, and there's the new shinier products that are out there now. From a pure cost perspective, it can very well make sense for somebody who has a limited budget and acknowledges that they have a need. They've seen mom, dad, grandma, grandpa have this long-term care event, and they had a long-term care policy, and just that couple $100 coming in from a daily benefit, changed, changed the world for them.
I do. Yeah, and that brings up the qualifier I must offer, which is you've done a very good job presenting us options, and I just want to caution everybody that the products and the companies that Darren has mentioned are just meant for educational purposes, and obviously we don't yet know which product and company is best for you until we pre-qualify you and consult with you about your needs and your goals and your budget, and we can make then the most appropriate recommendation.
Yeah.
All right, Darren, thanks once again. You have shown the light and you've revealed the magic once again of life insurance. We appreciate it, and we will see you next month. Have a good rest of your day.
Thanks.
Thank you.